Most people think investing is about picking the right stock. It's not. It's about what level you're playing at. Because the difference between someone investing $500 and someone moving billions isn't just money. It's how they think, how they act, and the opportunities they even get access to. In this video, I'm going to show you the 8 levels of investing and why most people never make it past level 2. This is Wealth Logic. If you want to understand how money actually works, not just surface level advice, hit subscribe, because by the end of this video, you'll know exactly where you are and what it takes to move up. Level 1, the beginner investor. The account is open for the first time and the interface appears straightforward, with options to buy, sell, and numbers constantly shifting, yet it doesn't feel as simple as it looks. An initial $500 is added, not a huge sum, but meaningful enough to care about. Stocks are browsed, familiar names, companies known for years. It becomes clear that this isn't just purchasing numbers, but owning a small part of something tangible. That realization doesn't come instantly, it develops over time. The first investment isn't made for quick trading, but to hold and observe what unfolds. Attention begins to shift, moving beyond price changes to understanding what a company actually does, how it earns, why customers choose it, and what drives its growth or stagnation. More articles are read, reports explored, and differing viewpoints considered, some centered on short-term predictions, others on long-term value. Gradually, the distinction becomes obvious. Some aim to forecast the next move, while others focus on truly understanding the business. This leads to the first meaningful choice, deciding what kind of investor to become. At this stage, returns remain small and nearly insignificant. What truly matters is learning how the system operates, how markets evolve, and how ownership compounds over time. Investing isn't about reacting to every fluctuation. It's about holding a position long enough to gain from it. Once that clicks, the mindset changes. Constant monitoring fades, replaced by long-term thinking. And at that point, the transition begins. You're no longer just observing and learning, you're actively involved. Level 2, retail investor. Investing becomes a monthly habit, not something triggered by good market conditions or rising prices. Each month, a set amount is committed, $500, $1,000, or whatever fits the budget. Automatic deposits are directed to a brokerage account, and from there, the funds are allocated across selected assets. Index funds tracking the S&P 500, sector-focused exchange-traded funds, and a handful of individual stocks chosen through research. The portfolio begins to take shape with intention rather than randomness, guided by an allocation, perhaps 60% equities, 20% ETFs, and 20% cash or short-term positions. Diversification starts to make sense, not as simply holding multiple stocks, but as owning assets that respond differently under the same market conditions. When the market declines, the portfolio follows, sometimes dropping 10% or more. This becomes the first real challenge. There is no selling because a key realization has taken hold. Volatility is not the true risk. Selling at the wrong time is. Investing continues consistently, month after month, following the principle of dollar-cost averaging. There is no attempt to predict market timing, only to build steady exposure. Returns remain modest, but the approach is no longer scattered, it is disciplined. The portfolio is monitored, tracking total returns, cost basis, and allocation percentages. The mindset shifts toward years instead of days, because the objective at this stage is not to beat the market, but to remain invested long enough to gain from it. And as the portfolio grows to a point where fluctuations carry weight, the strategy must adapt. This is no longer simple participation. It is the foundation of something designed to compound. Level 3, the consistent investor. Once a portfolio exceeds $100,000, that figure starts to influence how attention is given. A 1% change is no longer theoretical, it represents $1,000. In a strong market year, gains of $8,000 to $12,000 can occur without adding extra funds. For the first time, returns feel tangible. The focus shifts from only contributing money to understanding compounding. A clearer strategy takes shape with a set allocation like 70% equities, 20% fixed income, and 10% cash or alternatives, consistently followed. Portfolio adjustments are made based on these targets rather than emotions. When equities become overweight, they are reduced. When they decline, more is added. Attention turns to risk-adjusted returns, considering not just profits but the level of risk taken to achieve them. Volatility, drawdowns, and how different assets move relative to one another become important factors. Market corrections stop feeling like emergencies and start being seen as part of the normal cycle. Tax efficiency also becomes a priority, with assets held long enough to benefit from long-term capital gains and the use of tax-advantaged accounts when available. At this stage, behavior becomes steady, investing regularly, maintaining allocation, and sticking to the strategy despite short-term market fluctuations. Success is no longer about choosing the perfect stock, but about consistently applying a disciplined process over time. As the portfolio continues to grow, even minor improvements begin to have a meaningful impact, marking the shift from simply managing investments to actively refining and optimizing them. Level 4. The advanced investor stage. Once a portfolio reaches between $250,000 and $1 million, the priority shifts away from simply accumulating wealth toward improving how efficiently it grows. At this point, even minor percentage gains start to have a meaningful impact. A 2% boost in returns is no longer trivial. It can translate into an extra $5,000 to $20,000 annually. The approach moves past basic asset allocation into more precise strategy adjustments. Exposure is fine-tuned across different asset classes depending on risk tolerance, time horizon, and market conditions. While equities continue to fuel growth, additional structure is introduced through fixed income, real estate, or alternative investments. Greater focus is placed on tax efficiency, with high turnover assets positioned in tax-advantaged accounts and long-term holdings kept in taxable accounts to reduce capital gains. Strategies like tax loss harvesting may also be used to offset profits. Investment decisions begin to weigh expected returns against potential downside risk. The question shifts from how much can be gained to how likely losses are and how severe they could become. Diversification becomes more deliberate, with attention given to how assets perform during market downturns, not just periods of growth. At this level, investing evolves from isolated choices into building a resilient system capable of performing across varying conditions. As capital increases, protecting against significant losses becomes just as critical as generating returns, especially as greater access opens the door to new opportunities. At level 5, you are considered a high net worth investor. Once your investable assets exceed $1 million, the way the financial system engages with you shifts. You are no longer confined to public markets. New types of opportunities start becoming available, not because those investments have changed, but because your capital now meets the threshold required to access them. You begin entering private investment spaces such as private equity funds, venture capital opportunities, and real estate syndications. These are not listed on public exchanges. Instead, they come through networks, advisors, and financial institutions. The framework is different. These opportunities typically demand higher minimum investments, longer commitment periods, and limited liquidity. Your capital may be locked in for 5 to 10 years, with returns distributed gradually rather than instantly. In return, the potential upside can be greater, but the level of risk also increases. At this stage, you assess investments based on deal structure, the credibility of the sponsor, and the projected internal rate of return. You start collaborating with professionals such as private bankers, financial advisors, and tax specialists, not to hand over control, but to optimize your portfolio's structure. Your portfolio grows more sophisticated. Public equities still play a role, but they are no longer your sole source of returns. You begin distributing capital across various strategies, each serving a purpose such as growth, income generation, or preserving capital. At this point, the challenge is no longer gaining access, it is choosing wisely. Because when your capital reaches this level, opportunities come to you rather than needing to be chased. And as your wealth continues to expand, investing evolves from an occasional activity into your primary focus. At level 6, you step into the role of a professional investor, with capital ranging between $10 million and $100 million. Investing is no longer a side activity, it has become your main responsibility. Your portfolio has grown to a size where results matter in absolute terms, not just percentages. A 5% return is no longer abstract. It translates into $500,000 to $5 million in yearly profit or loss. Every move carries serious consequences. You start taking a more active approach to managing your investments, not by trading constantly, but by making disciplined, structured decisions. Each opportunity is assessed through expected returns, potential downside, liquidity, and time horizon. Your capital is spread across different asset classes: public equities for growth, private equity for long-term gains, real estate for income and appreciation, and fixed income for stability, each playing a defined role. At this stage, you may operate through a formal setup like a family office or investment firm, allowing for more efficient handling of taxes, reporting, and allocations. Performance becomes something you track closely, comparing results to benchmarks like the S&P 500, monitoring internal rates of return on private deals, and analyzing how effectively your capital is being used. Consistency becomes more important than occasional big wins, as avoiding major losses takes priority since large drawdowns are harder to recover from at this scale. Your identity evolves. You're no longer just an investor, but a portfolio manager. And as your capital continues to expand, your decisions begin to impact more than just your own holdings. They start shaping the direction of capital flow itself. Level 7 represents the institutional investor, where capital operates far beyond an individual scope. At this stage, allocations range from hundreds of millions to billions of dollars, typically managed through funds, family offices, or large institutional frameworks. The role shifts from simply handling money to determining how substantial capital is distributed. The focus is no longer on picking individual assets, but on making allocation choices, deciding what portion goes into equities, private markets, credit, real estate, or alternative approaches. Investments are made both directly and through external managers such as hedge funds, private equity firms, and venture capital funds, all assessed based on performance history, strategy, and incentive alignment. Thorough due diligence becomes essential, involving detailed reviews of fund structures, fee models, and risk exposure before any commitment is made. Individual allocations can reach tens or even hundreds of millions, making liquidity a key strategic factor, as moving capital quickly can impact pricing and access. Decisions are mapped out over quarters or even years. At this scale, capital begins to carry influence, with large commitments capable of supporting companies, industries, or entire strategies. These moves often attract others, reinforcing a network of institutional investors, fund managers, and advisors where information circulates through relationships. Investing at this level is no longer about choosing assets, but about steering capital at scale. Because once capital reaches this magnitude, it doesn't just take part in markets, it starts to shape them. Beyond this point, the concentration grows even further, where a single decision has the power to shift entire markets. At level 8, the billionaire investor stage, net worth surpasses $1 billion, and the entire game shifts. The focus is no longer on managing portfolios, but on holding significant positions. Investments are no longer measured in a few million. They involve hundreds of millions or even billions directed into a single idea, company, or strategy. Capital at this scale allows for ownership and control, not just partial stakes. Participation extends to major deals, acquisitions, substantial equity holdings, and strategic investments that directly shape how businesses operate. While public markets still matter, they are no longer the main playing field. Private markets take precedence, including direct deals, co-investments, and large capital allocations arranged behind closed doors. Every decision carries noticeable weight. Taking a position moves the market, and exiting does not go unnoticed. Liquidity becomes complex, requiring careful planning, timing, and coordination, as large moves can influence prices, demanding a more deliberate approach. Networks also evolve, involving interactions with major investors, institutional leaders, and top executives. At this level, opportunities are rarely public. They are structured and negotiated privately. Investing is no longer just about generating returns, but about exerting influence, directing where capital goes, which companies scale, and which industries grow. At this point, the market no longer dictates actions. Instead, it responds, as decisions begin to shape outcomes far beyond a single portfolio. So now the question isn't what you just watched, it's where you actually stand. Most people stay stuck at the early levels, not because they can't move forward, but because they never change how they think. They chase quick wins, react to noise, and never build the discipline required to scale. But the path upward is clear. Each level demands a different mindset, a different strategy, and a higher standard of decision-making. If that shift doesn't happen, progress stops. If it does, everything changes. This is wealth logic. If this broke your assumptions and gave you a clearer view of how the system really works, subscribe, because the next level isn't about luck. It's about how you play the game.